All right, we are looking at a little bit of weakness for stocks in North America, investors digesting a whole host of earnings stories. Let's talk a little bit more about how to navigate these waters. Juliette John is a founder of Iris Asset Management, a longtime portfolio manager, particularly with a focus on some dividend names. Juliette, always great to have you with us. And we started this hour just talking about whether earnings season would be a really informative piece for investors on what the rest of the year might bring us. How closely you've been watching some of these, profit reports?
Well, yes, definitely. The earnings season is always a good gauge of what corporate managements are seeing, what they've experienced in the past 3 months, and I'd stress the past 3 months versus some of the commentary that we can get through the Q&A section or even through the discussion on the actual calls with respect to the existing environment now and what we're seeing likely into the next few quarters. Right now, I think what we're really looking for is an indication as to whether there will be some softening in earnings. We've seen some decent strength last year and even some of the earnings we've seen so far this quarter. But if we do see an economic slowdown, there's reason to believe that we could see some earnings compression through weaker revenues, weaker revenue momentum, as well as some margin pressures that could hurt earnings going into the second half of 2023. And then the question becomes, how willing are investors to pay for some of those earnings if they are a little bit softer?
Now, when does that start to impact dividend strategy? Because, look, every industry has, I guess, sort of a different business makeup. Some companies might be more sensitive to those bottom line changes that you're speaking of. So how do you approach that when you're, somebody who's not just looking for actual stock performance for the year, but reliant upon some of those steady payouts to investors?
Well, absolutely. And it goes into looking at the business profile and the balance sheet profile specifically. What we really focus on is the composition of the balance sheet and how capable is the business to manage some of those financial liabilities. So really understanding whether the debt is fixed versus floating, the term, the maturity of the debt that's on the balance sheet, how stable are the cash flows coming into the business. And in large part, if we can get satisfaction and good answers to some of those questions, we have a great deal of confidence that the dividends can be maintained through a period of economic weakness or a period of earnings compression. So really understanding whether there is some stability to those cash flows, whether it be contractual or lower levels of economic reliance or cyclicality to those cash flows, that really will allow for those dividends to be paid as a result of the cash flows being quite stable. Certainly the ability for companies to be generating free cash flow beyond what the capital expenditure requirements are to maintain the business and grow.
How is it impacting which names you're favoring in the market, which names you're perhaps a little bit more cautious on right now?
Well, no question, gold is in favor right now, and we've seen a lot of interest with bullion moving towards all-time highs, and rightly so. There has been a lot of economic instability, concerns about whether central banks will slow down their pace of rate hikes. Inflation is still high. A flight to safety, perhaps, if gold was viewed in that light when we had the bank challenges last month. And our view, though, is that we really haven't seen yet that gold companies have been able to translate strong bullion into strong earnings. And we've seen the stocks outperform bullion over the past month. If that continues without the companies actually being able to generate earnings as a result of the cost creep that they continue to be facing, then investors could be left disappointed discounted to some extent. By comparison, we have seen some real valuation compression in certain areas of the market, like financials as well as the energy sector. Both are kind of almost lumped into a value category, and that is partly why value as a strategy has underperformed a little bit so far in 2023. That said, for long-term investors, there are exceptional opportunities in both of those areas.
So just to kind of recap a little of what you were getting into there, financials, one of those areas to be watching, energy, one of those areas to be watching, gold, a little more caution, which would echo what we heard from our first guest this hour as well. What sort of walk us through your thinking there?
Sure. Well, no question. I think it would be unlikely for me to come onto the show and talk about gold. I think any of my long-term investors would be really surprised to see that. And our positioning remains the same, that we haven't seen that strength in bullion has translated to earnings. So we see last year a great deal of cost inflation. We haven't seen discipline with respect to capital expenditures. From an operating perspective, we see the all-in sustaining costs continue to rise. And so that strength in bullion, which theoretically should be dropping to the earnings line, if there is some stability and conservatism with respect to cost management, we haven't seen that yet. And so if we do see that trend continue, then earnings could actually disappoint, and that would be perhaps prompt some weakness to the share prices.
All right, Julie.